Welcome to the Deep Dive, where we take the most complex regulatory documents, the ones often ignored until there is a crisis, and transform them into the actionable knowledge you need. Today, we are undertaking a masterclass in global corporate compliance. Our source material is, well, it's dense. Chapter 22 of the Companies Act 2013, covering companies incorporated outside India, along with detailed 2014 rules. Our mission is to decode India's framework for regulating foreign companies. And if you're involved in a global business or advising one that earns revenue from the Indian market, whether that's through a physical branch or just a single cloud service, you need to understand this. This system casts an incredibly wide net, and we are going to explore exactly how wide that net is and what the consequences are if you fall into it.
That's absolutely essential. We are diving into these really stringent requirements designed to ensure that corporate entities incorporated overseas, but deriving significant economic or capital benefit from India, meet the same standards of transparency, the same reporting standards as domestic Indian companies.
Right.
So we'll be covering sections 379 right up to 393A, moving step by step to build a comprehensive view of the mandatory registration, annual reporting, and, critically, the enforcement mechanisms India uses.
That's a roadmap, really.
It is. It's a roadmap for navigating entry into one of the world's most dynamic and, I have to say, most regulated markets.
Okay, let's unpack this immediately because everything hinges on the initial definition. I think we often assume that to be regulated in India, you need to set up a physical office. But the definition of a foreign company under Section 242 proves that assumption dangerously outdated. So what are the two essential criteria?
To qualify as a foreign company under this act, a company that's incorporated outside India must satisfy both criteria. First, it must have a place of business in India.
Okay.
Second, it must conduct any business activity in India in any other manner. Both of these have to be present. But the truly revolutionary element, the part that catches modern entities, is how they interpret that first condition, place of business.
Exactly. When we think of a place of business, we think of a physical address, a factory, a branch office, maybe a sales center.
Right, brick and mortar.
But the Act explicitly expands this far, far beyond that reality.
Precisely. The law states that a place of business can be established either by the company itself or through an agent. And critically, it can be established physically or through electronic mode.
And that's the one.
That legislative update is what captured the borderless digital economy and just pulled it directly into India's regulatory jurisdiction.
That is massive. So it's not the building, it's the activity. Let's dive deep into that term, electronic mode, because this is where a software as a service, a SaaS provider, or an e-commerce giant sitting thousands of miles away suddenly finds itself governed by the Indian registrar. Rule 2 defines this, and it makes the server location totally irrelevant, right?
That's the key takeaway. Where your server is installed does not grant you an exemption anymore. The definition of electronic mode is it's designed to be exhaustive, covering every facet of electronically based business activity that touches the Indian public or economy.
Give us some specific examples from the rules, because I looked at the list and it is long.
It is extensive, and that's intentional. It covers standard digital commerce activities like business to business, B2B, and business to consumer, B2C transactions.
Okay.
It includes electronic data interchange and other digital supply transactions. This means any foreign platform facilitating sales to or from India is covered.
And it extends directly into finance, which is always a major regulatory concern.
Absolutely. The definition covers offering to accept deposits or inviting or accepting deposits or subscriptions in securities in India or from Indian citizens. So if you're using digital means to court Indian capital, you're covered. Beyond that, it catches financial settlements, web-based marketing, advisory services, and crucially, database services and products. Think about cloud computing or data storage providers. If they are providing a service accessed in India, they're likely on this list.
And what about professional services that use the internet? Telemedicine, remote education, how are those treated?
The service sector is thoroughly covered. Online services like telemarketing, telecommuting, telemedicine, online education, and information research are all explicitly listed. And then there's a catch-all for all related data communication services, whether it's by email, mobile devices, social media, cloud computing. The list goes on. The regulatory goal is clear. If you are transacting or communicating commercially within India via digital means, you are subject to compliance.
Okay, let's apply this to a traditional business structure first. We have an example, Zakpak Ltd., a Japanese shipping company, which sets up a fully licensed branch office in Mumbai. That seems pretty clear-cut.
The logic here is straightforward, yes. The branch office is a physical presence, a physical place of business established to conduct business activity. By establishing that physical presence, Zakpak Ltd triggers the full foreign company rules under the Companies Act, 2013, and must register within the stipulated time frame. No ambiguity there.
Now consider the illustration of airline companies. They might be incorporated in Europe, they might not own a single ticket counter, but they use booking agents in Delhi or Bangalore.
The agency relationship is the trigger here. If the foreign company conducts business activity in India through an agent who maintains a place of business, whether that's physical like a travel agency or electronic like an online booking portal, that is sufficient.
So it's the activity through the agent that expands the reach of the act.
Exactly. And to put the scale of this regulation in perspective, public records show that 320 foreign companies were registered in India just between 2018 and 2021. This isn't theoretical. This is a very active, constantly applied regime.
So once a company meets that broad definition of a foreign company, what is the initial consequence? What's the baseline requirement?
The general rule, stated in Section 379, subsection 1, is that all registered foreign companies must comply with the core provisions, Sections 380 to 386 and Sections 392 and 393. This minimum compliance set covers documentation, financial accounts, public display of information, and the penalty structures we'll definitely discuss later.
But this leads us to what I consider one of the most powerful rules in this entire chapter, the Deemed Indian Company Rule in Section 379(2). This is where the Act essentially tells a foreign company, you may have a foreign address, but if Indian money controls you, you are subject to Indian rules.
Absolutely. This section is designed to address potential regulatory arbitrage, the practice of incorporating abroad just to avoid stringent domestic laws. Section 379(2) kicks in if 50% or more of the paid-up share capital, and that includes equity, preference, or any combination of a foreign company, is held by Indian interests.
And who qualifies as an Indian interest in this context? Is it just individuals?
It's defined broadly. The 50% or more aggregate holding can be held by one or more citizens of India or by one or more bodies incorporated in India, so Indian companies.
For a mix of both.
Or any combination of the two.
That 50% threshold completely changes the compliance burden, doesn't it? What's the ultimate implication here?
It's a massive jump in compliance. Such a foreign company must comply with Chapter 22A&D, all other prescribed provisions of the Act, as if it were a company incorporated in India. Think about that.
Wow.
You're not just filing the basic foreign company documents. You're potentially subjected to rules governing things like directors' responsibilities, issuance of shares, and corporate governance standards that are normally reserved for domestic entities.
So it's about control.
It ensures that entities substantially controlled by Indian capital, even if they're incorporated overseas for operational or tax reasons, must still maintain a high level of Indian corporate compliance.
Let's walk through the Emaar Company LLC illustration. Emaar, incorporated in Dubai, has a place of business in India. Hinduja Company Limited, an Indian company, holds 26%, and Vaishali Company Limited, another Indian company, holds 25%.
The calculation is the key. We just aggregate the Indian holdings. 26% plus 25% equals 51%.
Over the threshold.
Since the aggregate holding of 51% exceeds the 50% threshold, Emaar Company LLC is deemed to be substantially controlled by Indian bodies corporate. Therefore, it is compelled to comply with Chapter 22 and all other prescribed provisions of the Act as if it were a company incorporated in India.
It really highlights that regulators are looking past the label of foreign company and focusing on who is truly holding the reins.
That's it, exactly.
So once a company gets caught by that definition, the clock starts ticking for registration. This brings us to Section 380, delivering documents to the registrar, and we mentioned the timeline is tight.
It is 30 days. Every foreign company must deliver the required documents to the registrar within 30 days of establishing its place of business in India. Miss this deadline, and you're immediately non-compliant, which triggers the penalties we'll get to.
And the jurisdiction is centralized, right? It doesn't matter where your office is.
That's a key administrative detail. All foreign company filings, regardless of whether their principal office is in Mumbai, Chennai, or Kolkata, must be delivered to the registrar, having jurisdiction over New Delhi. It standardizes and centralizes the administration of all these foreign entities. And, of course, the process requires the payment of prescribed fees.
So what's in this initial 30-day package? What are the essential documents that establish the company's, bona fides?
The documents ensure full transparency on the company's structure and leadership. First, a certified copy of the company's constitution, its charter, its memorandum and articles or whatever its equivalent founding instrument is. And here's a critical administrative detail. If the original is not in English, a certified English translation must be annexed. India needs to be able to read your foundational legal text.
Makes sense. Then the address details, both foreign and domestic.
Correct. The full address of the company's registered or principal office outside India, and the full address of its principal place of business in India. This clearly sets out the company's footprint.
And the requirement for a designated resident contact, that seems crucial for legal purposes.
Absolutely vital. Section 381D mandates providing the name and address of one or more persons resident in India who are expressly authorized to accept service of process, notices, or any other official documents on the company's behalf.
So this is the person who gets served if there's a lawsuit.
Exactly. If India needs to sue you or send an official notice, they go to this person. Without this designated representative, the company cannot legally operate its place of business.
And the final required elements relate to history and integrity checks.
Yes. The filing must include particulars of any previous opening and closing of business places in India, a regulatory history, essentially. And most importantly, there must be a formal declaration. This declaration has to affirm that none of the company's directors or the authorized representatives in India have been convicted or debarred from the formation or management of companies, either in India or abroad.
That's India's due diligence on the integrity of the leadership.
Pretty much.
Now, let's spend some significant time on Rule 3, the required details of directors and the secretary. The level of required personal detail here is astounding. Why is this list so extensive?
This list under Rule 3 is the clearest signal that India is focusing on individual accountability. They are moving beyond just the corporate shell. For every director and the secretary, the foreign company has to provide incredibly detailed personal and professional data. It ensures the regulator can track and identify the individual decision makers globally.
Walk us through the personal identity tracking aspects. What are we talking about here?
We start with the basics. Personal name and surname, any former names, parent or spouse's name, date of birth, and residential address. Then it moves into identification documents, present nationality, and if it's different, their nationality of origin. This tracks the entire history of their legal identity.
But the passport requirements are where it really gets rigorous.
This is the shocker for many international executives. They require the passport number, date of issue, and country of issue. And get this, if the person holds more than one passport, which is common for global executives, details of all passports must be detailed.
All of them?
All of them. This is far beyond what many jurisdictions require, and it's likely intended to ensure that if a director is implicated in corporate wrongdoing, they can't easily evade legal action or hide assets across different jurisdictions or identities.
And of course, the financial and professional identifiers linking them to India.
Precisely. They must provide their Indian income tax permanent account number, or PAN, if applicable. This links them directly to the Indian tax system. They also have to detail their occupation and, critically, list directorships in any other Indian company, including their director identification number, DIN, corporate identity number, CIN, and the company name.
So the registrar can quickly map their entire corporate network within India.
Instantly.
So how does this extensive package physically get submitted?
It's all electronic now, submitted via Form FC1, along with the prescribed fees. But there's a vital regulatory link here. The application must be supported by an attested copy of approval from the Reserve Bank of India, the RBI, under FEMA.
The Foreign Exchange Management Act.
Right, or a declaration confirming that no such RBI approval is required. This intertwines corporate law with financial regulation, ensuring compliance on both fronts.
What about maintaining compliance? What if a director changes or the principal office moves?
Compliance is continuous. It's not a one-and-done thing. If any documents delivered under Section 380 change, a change of director, principal office address, or authorized representative, the company has to file a return detailing that alteration in Form FC2 within 30 days of the alteration. That 30-day clock is non-negotiable.
And finally, let's revisit that digital company illustration. Search and Find Puri Ltd, incorporated in Singapore, sells goods via e-commerce in India but has no physical office.
This is a perfect example of the Act's broad reach. Because Search and Find conducts business through electronic mode selling on e-commerce platforms, it is defined as a foreign company under Section 242.
So even with zero physical infrastructure?
Even with zero physical infrastructure, it is mandated to submit the entire document package, including all those extensive director details, under Section 380. The strategic implication here is that even minimal digital-only market penetration requires a full regulatory infrastructure setup.
Moving from initial registration to ongoing transparency, Section 381 focuses on financial requirements. What is the core annual mandate here?
The core requirement is that every foreign company must, every calendar year, prepare its balance sheet and profit and loss account in the prescribed form and deliver copies of those documents to the registrar. This is standard, but the specific focus is what makes it rigorous.
That focus being the Indian business operations, separate from the global entity.
Exactly. Rule 4 dictates that the financial statement must be prepared specifically for its Indian business operations. This ensures regulators can understand the health of the local operations in isolation. Furthermore, these statements must adhere as closely as possible to Schedule 3 of the Act, which governs the detailed format and presentation for financial statements of Indian companies.
So you can't just send over a generic statement. It has to be tailored for India.
Not at all. It must be tailored.
But India also requires insight into the global parent, correct?
Yes. The foreign company must attach copies of the latest consolidated financial statements of the parent foreign company exactly as they were submitted in its country of incorporation. This provides crucial global context for the regulator.
What's the timeline for filing all these accounts?
All financial documents, the Indian statements and the parent company's consolidated statements, must be delivered to the registrar within a period of 6 months of the close of the financial year, which usually ends March 31st. The registrar can grant an extension of up to 3 months for special reasons, but that's the maximum administrative reprieve you can get.
Now, let's discuss those 3 specific mandatory statements. These seem highly revealing and designed to track money movement. Why are regulators so interested in these precise details?
These statements are targeted mechanisms against profit shifting and regulatory avoidance. They include, first, a statement of related party transaction, which details transactions between the Indian branch and its parent company or affiliates.
Okay.
Second, a statement of repatriation of profits. And third, a statement of transfer of funds, including dividends.
So if the foreign company is selling services to its Indian subsidiary at inflated prices to shift profits out, the statement of related party transactions is designed to flag that.
Precisely. It provides visibility into internal pricing dynamics that could affect taxable income in India. Likewise, the repatriation and transfer of funds statements give the RBI and the registrar a real-time view of capital outflow. These documents, along with a list of all places of business in India, are filed via Form FC3.
We mentioned the standard March 31st financial year. What if a global group, say one based in Australia or the US, uses a non-standard year-end for global consolidation?
The law accommodates this with the financial year exception. If a foreign company is a holding company, a subsidiary, or an associate of an overseas entity that needs a different financial year for consolidation, the foreign company can apply to the central government for permission to adopt that different period.
So if ROK Limited, the Indian business, is a subsidiary of HOK Limited in Australia, and HOK uses a June 30th year end, ROK can apply to align its Indian financial year with HOK's just to streamline group consolidation, but it needs central government approval.
That's the mechanism. It balances the need for regulatory consistency with the practical realities of global accounting.
Finally, the audit requirement. Do these Indian financial statements need to be certified locally?
Absolutely. Rule 5 makes it mandatory that the accounts pertaining specifically to the Indian business operations must be audited by a practicing chartered accountant in India, or a CA firm, or LLP. Furthermore, the provisions of Chapter X, which is Audit and Auditors, apply. This means the standards and liabilities governing Indian auditors apply to the audit of the foreign company's local operations.
Right.
We use the Latin legal phrase mutatis mutandis here, which simply means with necessary changes. The same core rules apply, they're just adapted for the foreign company context.
Moving to how the public interacts with these entities, Section 382 mandates public visibility. Why is dual language display required?
Visibility is fundamental for consumer and public protection. Every foreign company must conspicuously display its name and country of incorporation in 2 main venues. First, outside every office or place of business in India, and not only in legible English characters, but also in the characters of the local language or languages in general use in that locality. This ensures that the local populace, who may not read English, knows who they are dealing with.
So whether it's in Marathi, Bengali, or Kannada, the foreign company's name and origin must be clear.
Correct. The second requirement is on all official publications. Business letters, billheads, letter paper, notices, and prospectuses. All must state the company's name and country of incorporation in legible English characters.
And if the company has limited liability, that fact must also be prominently displayed.
Yes. The limited liability status must be conspicuously exhibited outside the office and stated in all official publications, in both English and the local language. This is a crucial notification to the public about the legal extent of the member's financial risk.
Section 383 then addresses the practical matter of legal communication. So how does the Indian state ensure effective service of legal documents on an entity that's incorporated overseas?
Service of process, notice, or any document is deemed sufficient if it is addressed to that authorized resident person whose details were delivered to the registrar under Section 380. Delivery is considered complete if the document is left at that address, sent by post to that address, or reflecting modern legal practice, set by electronic mode.
So an email can count as being officially served.
It can. It means that legal notification via email or other confirmed digital channels is sufficient for regulatory and judicial purposes.
Section 384 is a major mechanism for uniformity, importing core corporate governance laws onto foreign companies. What key chapters of the Companies Act are applied here?
This section creates a kind of hybrid regulatory environment. First, provisions relating to the issue of debentures, Section 71, apply mutatis mutandis. So if you're borrowing money publicly, you have to follow the domestic rules.
And the annual administrative snapshot, the annual return, that's also mandated.
Yes. The provisions of Section 92, preparation and filing of annual return, apply. And the rules specify that every foreign company has to file its annual return in Form FC4 within a tight window of 60 days from the last day of its financial year. This provides the registrar with a rapid annual update on corporate affairs and director holdings.
Tell us about the application of corporate social responsibilities, CSR, which is a pretty unique element of the Indian Act.
The corporate social responsibility provisions, mandated under Section 135, are also applied to a foreign company if it meets the statutory criteria related to net worth, turnover, or net profit. This ensures that large, profitable foreign entities operating in India contribute to social development funds just as their domestic counterparts do. It demonstrates a true expectation of shared societal obligation.
What about local bookkeeping requirements? Do they need to keep their global books in India?
No, the books of account rule applies, but with a practical limitation. The foreign company only needs to keep these books at its principal place of business in India, and only to the extent they cover financial dealings related only to its business in India. This prevents the regulator from demanding full global account books and focuses accountability solely on the local economic activity.
And securing assets within India.
Transparency on debt is mandatory. The provisions of Chapter 6, registration of charges, apply mutatis mutandis to charges on properties created or acquired by the foreign company in India. This ensures full public visibility of secured assets and liabilities. And finally, the government retains strong enforcement power as the provisions for inspection, inquiry, and investigation, Chapter 14, also apply to the Indian business of the foreign company.
Section 386 provides the legal key to understanding the scope of this chapter by clarifying key terms. Which definitions are most crucial for the listener to grasp?
3 terms stand out. First, certified ensures quality control for documents. It means certified in the prescribed manner to be a true copy or a correct translation. Second, the definition of director is expansive and critical. It includes any person in accordance with whose directions or instructions the board of directors of the company is accustomed to act.
So, a shadow director.
This is the legal foundation for prosecuting or regulating shadow directors, people who may not hold a formal title but wield actual control.
And the third definition clarifies that even minimal administrative infrastructure is enough to trigger compliance.
Exactly. The definition of place of business explicitly includes a share transfer or registration office. This lowers the compliance threshold significantly, catching entities that might exist purely for administrative financial support.
Let's use that inclusion to analyze illustration 2. Scenario 1. A company incorporated outside India has only a share registration office in Mumbai.
Since Section 386 specifically includes a share transfer or registration office in the definition of place of business, this company is automatically treated as a foreign company, provided it conducts any business activity in India.
So the strategic implication for the listener is vital. If you set up even a small, non-revenue generating administrative function in India, you are triggering the full registration and reporting machine.
You've got it.
And scenario 2, Indian citizens incorporate a company in Singapore, but they only conduct business in Singapore and have no place of business in India.
This is a clear negative. Despite being owned entirely by Indian citizens, the company is not a foreign company under Chapter 22. It fails that dual criteria test because it has no place of business and conducts no business activity in India. Location of control is irrelevant if the activity doesn't touch Indian soil or digital space.
Shifting focus to raising capital, Sections 387 through 389 impose stringent investor protection rules on foreign companies seeking to offer securities in India. And this is enforced regardless of their current operational status.
That's the critical regulatory point. Section 387 governs the dating of prospectus and required particulars. If a foreign company wants to issue securities in India, the prospectus must be dated and signed. This rule applies even if the company has not yet established a place of business in India or is only planning to do so in the future.
So the act of courting Indian investors is what triggers the scrutiny.
That's it.
What are the key mandatory structural and historical particulars required in that prospectus?
To ensure the Indian investor understands the foreign entity, the prospectus must contain details about its constitutional instrument, the specific foreign enactments under which it was incorporated, and an address in India where these documents or their certified translations can be inspected. It also has to list the date and country of incorporation and the principal office address in India, if one exists.
And it has to align with all the standard domestic disclosure requirements.
Absolutely. The prospectus must satisfy all the matters specified under Section 26, which is the domestic law on what must be stated in a prospectus. This effectively imports the full, detailed disclosure requirements that apply to Indian public offers.
There's an interesting 2-year exception that eases the burden on established companies, right?
Yes, the 2-year exception. If the prospectus is issued more than 2 years after the company was entitled to commence business, the requirements to detail the original constitutional instrument, the incorporation enactments, and the inspection address for those documents are waived. The assumption is that current financials and operations are more material to the investor than 2-year-old incorporation history.
And the law is clear that you can't ask an applicant to ignore these rules.
Correct. Section 387, subsection 2, makes any condition requiring an applicant to waive compliance with these requirements void. It's a powerful investor safeguard. Furthermore, application forms for securities have to always be issued along with a compliant prospectus, unless it's for a bona fide invitation to enter an underwriting agreement.
And what are the circumstances under which the prospectus requirements are slightly relaxed?
Section 387(4) allows exemptions for issues made to existing members or debenture holders, and for prospectuses concerning securities that are uniform with securities already issued and listed on a recognized stock exchange. However, even in these exempt cases, the prospectus must still be dated.
Section 388 protects investors from misleading statements made by third-party experts. How is accountability enforced here?
This section mandates that a prospectus cannot be issued if it includes a statement by an expert, unless that expert has provided written consent and, crucially, has not withdrawn that consent prior to issuance. The prospectus must explicitly state that the expert has given and not withdrawn this consent.
So it ensures experts are legally bound by their professional opinion.
It does. It binds them to what's in that public document.
And the prospectus ties the foreign company into the domestic rules governing how securities are actually issued and traded.
Yes. The prospectus has to ensure compliance with Section 33 on the issue of application forms and Section 40, which is securities to be dealt with in stock exchanges. This means that the foreign company has to follow the key domestic investor protection rules regarding handling applications and the mandatory listing procedures on Indian stock exchanges.
So before any foreign prospectus hits the market, it needs to pass through the registrar's approval process. What does that critical registration process entail?
Before issuance, circulation, or distribution in India, a copy of the prospectus must be delivered to the registrar for registration. This is the formal regulatory checkpoint. That copy must be certified by the chairperson and 2 other directors of the company, confirming it was approved by a resolution of the managing body.
And the final prospectus has to visibly reflect this oversight?
Indeed. The prospectus must state on its face that a copy has been delivered to the registrar. Furthermore, the filed copy must be accompanied by several critical attachments, as detailed in Rule 11.
This list of attachments seems extensive. What does the registrar require for a complete filing?
The requirements aim for maximum disclosure of key contracts and agreements. This includes the expert consent from Section 388 and copies of contracts for the appointment of the managing director or manager or a memorandum detailing any unwritten contracts.
And contracts outside the ordinary course of business are also flagged.
Yes, copies of any other material contracts not entered into in the ordinary course of business, which were executed within the preceding 2 years, must be attached.
A 2-year look back.
Exactly. It gives the regulator a 2-year look back into any non-standard agreements that might influence the company's financial standing. And finally, a copy of the underwriting agreement and the power of attorney if the prospectus is signed by an agent are also required.
Section 390 deals with Indian Depository Receipts, or IDRs. For foreign companies seeking Indian investment, what exactly is an IDR?
An IDR is a financial instrument. It's a depository receipt created by a domestic depository in India, and it's authorized by a company incorporated outside India. It allows foreign shares to be held in custody outside India and traded locally in India via the depository receipt mechanism. It's a key route for global companies to access the Indian capital markets.
And the central government maintains substantial regulatory power over every detail of the IDR process.
That's because the IDR bridges jurisdictions. The central government is empowered to make rules governing the entire life cycle. The offer, the disclosure requirements in the prospectus, the manner in which the IDR is dealt with in a depository mode, and the rules for its sale or transfer.
And compliance here is a 3-way regulatory check, correct?
Absolutely. Any foreign company issuing IDRs must comply with the specific conditions set out in the company's rules 2014, in addition to the specific regulations established by the Securities and Exchange Board of India, SEBI, and any relevant directions issued by the Reserve Bank of India, the RBI. It requires integrated compliance across the MCA, SEBI, and RBI frameworks.
This chapter also includes cross-border mergers under Section 234. How does India treat the merger of an Indian company and a foreign company?
Section 234 permits compromises and amalgamations between Indian companies and foreign companies, but only if those foreign companies are in notified jurisdictions. A foreign company can merge into an Indian company, or vice versa, but this crucial transaction requires the prior approval of the Reserve Bank of India.
So the RBI has the final say.
They do, and consideration can be paid in cash, depository receipts, or both.
And the definition of a foreign company here is slightly more permissive than the core definition we started with?
That's an important nuance. For merger purposes under Section 234, a foreign company means any company or body corporate incorporated outside India, whether having a place of business in India or not. This ensures that mergers aren't restricted only to foreign entities that have already registered an Indian branch office.
This brings us to enforcement, the liabilities and penalties for noncompliance. Section 391 ensures that prospectus-related liabilities apply equally to foreign companies. So what are the key consequences of deceitful conduct?
By applying Sections 34 to 36, India makes it crystal clear that if you lie in a prospectus, the same criminal and civil penalties that apply to an Indian CEO now apply to you. Section 34 imposes criminal liability for misstatements in the prospectus.
Okay.
Section 35 mandates civil liability for such misstatements. And Section 36 ensures punishment for fraudulently inducing persons to invest money. These are foundational investor protections, and they are non-negotiable for foreign issuers.
What about the closure of Indian operations? How does the winding up chapter apply?
The provisions of Chapter XX, Winding Up, apply mutatis mutandis for the closure of the place of business of a foreign company in India. This is particularly relevant if that foreign company raised capital through securities under this chapter that have not yet been repaid or redeemed. It ensures a clear legal path for dissolving operations and protecting creditors.
The cost of noncompliance under Chapter 22 is significant and designed to force rapid correction. What is the fine structure for a foreign company that contravenes any provision?
The structure is severe and immediate. The company faces a fine of not less than 1 lakh rupees, but may extend up to 3 lakh rupees. That's the base fine for the offense.
But the real financial bite comes from the continuing offense fine.
Absolutely. For every day the contravention continues after the first day, the company faces an additional daily fine that may extend up to 50,000 rupees.
50,000 a day?
A day. This continuing fine mechanism acts as a major disincentive to delay compliance. It essentially punishes procrastination with heavy daily fees.
And the individuals involved are penalized separately, reinforcing that focus on personal accountability we discussed earlier.
Exactly. Every officer of the foreign company who is deemed in default shall be punished with a personal fine of not less than 25,000 rupees, but may extend up to 5 lakh rupees. This means directors and authorized representatives face significant personal financial exposure if they fail to adhere to statutory requirements.
So if Morgenstern Digicables GmbH, a German digital company, fails to file Form FC1 for 20 days, it faces the minimum company fine of 1 lakh plus 20 days times 50,000, which is another 10 lakh rupees in continuing fines. And its defaulting officers are individually fined up to 5 lakh rupees each.
That's the correct, staggering calculation. The system is designed to hurt financially until compliance is achieved.
This brings us to Section 393, which is perhaps the most interesting regulatory tool in the chapter, what you called the regulatory hammer. First, what protection does it offer Indian counterparties dealing with a non-compliant foreign entity?
The law ensures fairness for the Indian party. Failure by the foreign company to comply with Chapter 22 does not affect the validity of any contract dealing or transaction it enters into.
Okay, so the contract is still good.
The contract is good, and crucially, it does not affect the foreign company's liability to be sued. An Indian party can still sue the non-compliant foreign company and hold it accountable under the contract.
But the foreign company is denied a reciprocal right, and this is the regulatory genius.
This is the catch-22, the court system blockade. If the foreign company is non-compliant, it shall not be entitled to bring any suit, claim any set-off, make any counterclaim, or institute any legal proceeding in respect to such contracts until it fully complies with the Act.
Let's make this practical for the listener. Imagine that Morgan Stern Digitables is owed $5 million by an Indian client for services rendered under a valid contract. They missed filing Form FC1 2 years ago and are non-compliant. Can they sue the Indian client in Indian courts for non-payment?
No, they cannot. They are blocked. The contract itself is valid, but the foreign company loses its enforcement rights within the Indian judicial system until it rectifies its status. It must register, pay all the back fines, file all the due documents, FC1, FC2, FC3, FC4, and only then can it approach the court to enforce its $5 million claim.
It's a highly effective, low-cost mechanism for the government to force regulatory cooperation.
Incredibly effective.
Rule 12 covers the improper use of the foreign company description. What's that about?
This targets fraud and misleading the public. If any person falsely carries on business using the description foreign company registered under the Act without actually being duly registered, they are liable for investigation under Section 210, which can lead to formal government action.
And finally, India provides strategic exemptions for companies operating in the growing International Financial Services Centers, or IFSCs.
Yes. To encourage global financial services to utilize these specific economic hubs, the central government may exempt certain classes of foreign companies by notification. These exemptions specifically relate to the offering of securities and the corresponding prospectus requirements for companies operating in an international financial services center, set up under the Special Economic Zones Act. It's a targeted reduction in compliance friction for strategically important economic activities.
Okay, let's unpack all this. We have meticulously covered Chapter 22, understanding that the term foreign company is exceptionally broad, covering purely digital operations, cloud computing, telemedicine, e-commerce, as rigorously as physical offices.
So what does this all mean? The compliance roadmap we've detailed, from the compulsory 30-day window for filing constitutional and those intensely personal director details in Form FC1 to the mandated annual audit of Indian operations by a local chartered accountant and the specific filing of related party transaction statements in Form FC3, it all demonstrates a comprehensive national strategy. India is ensuring unparalleled transparency and accountability from all entities that draw significant economic value from its territory. They're essentially treating foreign companies with deep ties as domestic entities for compliance purposes.
Here's where it gets really interesting for me. The regulatory hammer of Section 393 is just a stroke of genius in enforcement. India ensures that while non-compliant companies remain liable for their contracts and can be sued by Indian parties, they lose the ability to use the Indian court system to enforce their own rights, sue debtors, or claim counter-set-offs until they achieve full regulatory compliance.
It's a massive practical and immediate incentive for cooperation.
It really is.
And a final provocative thought for the listener. The extensive personal disclosure requirements demanded of directors under Rule 3, requiring details on all passports, nationality of origin, and a complete listing of all domestic and foreign directorships, signals a clear regulatory shift toward individual accountability for corporate actions. What personal and legal liability implications might this level of mandated personal scrutiny and traceability pose for global board members when agreeing to take on roles linked to Indian operations? It significantly elevates the personal risk assessment for governance roles.